Do you think it's 60,000 or Nikkei 70,000 is still understandable from the markets?
We think that leaves us constructive on not just the here and now, but as we look ahead over the next period of years.
Equity 60 and fixed income 40, that kind of traditional rule is not applicable anymore.
60-40 portfolios have had challenges in recent years that we haven't seen for some time.
日本株も含め運用総額が2170兆円を超える世界最大の資産運用会社ブラックロックの幹部マイケル・パイル氏。かつてアメリカのバイデン政権で大統領副補佐官を務めたこともある人物です。
Mr. Pyle, thank you very much for joining us today.
Thank you for having me.
Thank you very much. So now we are seeing Axios says the deal between U.S. government and Iranian government is closing in. How do you see the situation? The ceasefire is coming, or are we facing another big, ambiguous situation?
So I've been keeping a close eye on the reports as you have, and I think we're all hopeful that there can be a more permanent ceasefire to build on the temporary and fragile one that we've seen, in the past handful of weeks. I do think you highlight the key issue for the global economy, for global markets is there not just is there a ceasefire, but do we see a reopening of the Straits of Hormuz? Clearly, the scale of disruption of energy to global markets really hasn't had a precedent in a number of decades, dating back to the 1970s. And I think we've all been struck by how resilient the global economy has been in the face of it, even though there's been some significant damage already. But the most important thing will be, do the straits reopen? Can energy begin to get to global markets again, in the fullness of what global markets need? And do we begin to see some of that risk of damage unwind from here?
I see. So, the Nasdaq and S&P 500 is in a record high territory, and also Nikkei today is in a record high territory. And do you think the stock markets are overly optimistic, or are they simply indifferent to the conflict on Iran?
So I think what we've seen reflects some of the dynamics that have emerged from the war in Iran, combined with more powerful underlying forces like the AI and technology transfer, as well as some of the really positive developments happening here fundamentally in Japan. So I think the fact of the energy shock emanating from the war in Iran has had global impact, but it's really differentiated depending on what part of the world you're in. The United States, for example, quite insulated from this energy shock. Certainly there's some effect. When you go to fill up your tank in the United States, you're facing higher costs. But when you look at other things like natural gas, which is a really important industrial input, a very important electricity generation input, that price is actually lower today than at the start of the war. And I think it just highlights that for the United States, this is a relatively insulated part of the world. Obviously Japan, Asia, Europe, these are parts of the world that have had more significant economic impacts. What does that mean for the equity market? I think what it's meant is the U.S. has continued to power ahead. It's outperformed the rest of the world since the start of the war, as you say, has gotten back to that point of at or near all-time highs. I think Japan has underperformed the United States, but I think what's sitting beneath some of the positive performance that you described since the start of the war is, one that connection to the theme around AI transformation and some of the high technology companies in Japan, as well as some of the more structural tailwinds that the Japanese economy has right now that we see as really powerful and positive as we roll the clock forward from here.
So of course the optimistic view for the ceasefire is the tailwinds, but you are seeing another driving force for the equity markets. That one of them is AI thing.
Yeah, I think one question to ask is, given the size of the energy shock, if the Iran war hadn't happened, how much more positive could the equity market response have been? Again, I think it's a positive backdrop on growth in the United States and Japan. The AI transformation that we're seeing play out is, I think, giving powerful tailwinds to companies that are in the United States, to some of those some similar companies in Japan that supply the AI build out in the United States and elsewhere. I think those forces are pretty powerful updrafts for the equity market, and to date they've been outrunning some of the negative from the war in Iran, particularly in the United States, but again even here in Japan.
So you emphasize the kind of energy independence of the United States. That could be the origin of the strengths of the equity market. Does it mean the U.S. equity market is relatively immune to the geopolitical risk of the rest of the world?
I mean, I wouldn't say it's immune. I mean, certainly we saw a pullback in U.S. equity markets in the initial period following the beginning of the war. But I do think that this particular geopolitical shock is one that, as markets really fully understood it and priced it, recognized that the United States was relatively more insulated than other parts of the economy. Again, to your point around the energy independence that the U.S. has, that's less so on the oil side, where there's truly an integrated global market, and U.S. oil prices have moved higher, and of course gasoline prices along with that. But again, in places like natural gas, which is such an important input to a range of industrial and other economic processes in the U.S., that's a place where that insulation sort of really reveals itself, and I think highlights why this has been, a more benign period of months for the United States than elsewhere in the world. One last point, which goes to the technology and AI one, which is if you look at the U.S. equity market, a sizable share, a disproportionate share of the U.S. equity market is in the technology space, which is of course especially insulated from some of these shocks emanating from the war in Iran. So as I think about it, you have an equity market in the U.S. That is represented by the most insulated sector and the most insulated economy in the world, and I think that goes a long way to describe what we've seen happen in the U.S. equity market since the start of the war.
So from that perspective, Japan doesn't have that kind of insulation, so we are depending on the energy much of the rest of the world. So don't you see any kind of risk on the Japanese equities in terms of the energy independence thing?
Well, I think everyone is hopeful that we could see a conclusion to the war and a reopening of the straits. And like I said, I think we have seen some of that differentiation be reflected in equity market behavior since the start of the war. The U.S. has outperformed Japan since the start of the war, reflecting that difference in the growth impact from the energy shock. That being said, I think from BlackRock's perspective, we see a lot of constructive forces gathering behind the Japanese economy and the Japanese equity market. You've got above trend growth, you've got growing wages, you've got an economy that appears to have really gotten out of the deflationary period, I think permanently. And on top of that, you also have a corporate governance background that seeds were planted on that a decade or more ago under Prime Minister Abe, and they really appear to be bearing fruit today in terms of the quality, the investment appetite of Japanese corporates in a way that we haven't seen in a long time, and I think is very attractive to investors in the United States, including at BlackRock.
So Nikkei reached another record heights. Are you expecting further upside on the Nikkei?
Well, again, I think a lot of those forces that we see as tailwinds to the Japanese equity market, we see as continuing. We see them as structural tailwinds. Again, the growth, the reflationary picture, the wages powering consumer behavior, and that corporate governance backdrop, creating a much more dynamic environment for corporate investment and risk appetite. All of those things aren't, stories about the next day, the next week, the next month. They're stories that we think are going to play out over quarters and years. So we see that tailwind being a part of the landscape for some time to come.
It is often said that the most pessimistic investors towards the Japanese equities are Japanese people. I was often told what the CEO of the Franklin Templeton and other Blackstone and other people. Do you agree that view still? Actually, the 60,000 point of Nikkei is unimaginable when we were in the 2 years or 3 years ago. If someone says that, strategist says Nikkei is going to be 60,000 or 70,000, maybe we think he or she will be is crazy, but now it's realizing, it's unfolding. Do you think it's 60,000 or Nikkei 70,000 is still understandable from the BlackRock's perspective?
Well, you're going to be a better expert on the views of the Japanese people than I am. I can only tell you from where I sit at BlackRock in the United States. We've been a part of Japan and the Japanese economy for really the entire history of the firm or near to it. And we're a firm that believes in Japan and believes in this moment in Japan and the power of the growth, reflation, corporate governance backdrop that we're seeing. So all I can say is, we see a pretty significant set of tailwinds. We think that leaves us constructive on not just the here and now, but as we look ahead over the next period of years, and we're gonna be telling that story when we're here in Tokyo and around the world.
So you are the head of the hedge fund team of the BlackRock.
Yeah.
So roughly how much amount of money are you managing? Your hedge fund team is managing in total?
Yeah, so I think BlackRock's a significant player in the hedge fund space. I think it's often not appreciated that we have a significant a hedge funds business as we do. I think one of the things that we're seeing in hedge funds is a lot of client interest in hedge fund strategies these days, and for I think a reason that observers here in Japan will appreciate as well. Obviously, long-dated government bond yields have been moving higher. That's true in the United States, that's true in Japan, that's true in Europe. Really developed market government bonds around the world have been seeing interest rates move higher. What does that mean? It means that we've had less reliable diversification from long-dated government bonds than was true a decade, 2 decades ago. Traditionally we think when stocks go down, bonds go up, and vice versa. Today it's been different. There's been a kind of positive correlation. So when stocks go up, bonds go up, and vice versa. That's an environment where diversification is hard to come by in portfolios, and hedge funds, being able to be long short, being able to be market neutral, being able to be really neutral to a range of the forces of the Buffett markets can be an important source of diversification in portfolios where it's harder to come by that diversification through traditional sources like bonds. And so I think one of the things we've seen at BlackRock is really investors around the world taking a hard look at hedge fund strategies precisely because they're offering something, namely diversification, that's in really short supply right now.
So you mean that just kind of 60-40 rules, equity 60 and fixed income 40, that kind of traditional rule is not applicable anymore?
Well, certainly 60-40 portfolios have had challenges in recent years that we haven't seen for some time. March of this year, in the immediate aftermath of the beginning of the war in Iran, was the worst month for a 60-40 portfolio since 2022 and the beginning of the Russia-Ukraine war, the inflation post the pandemic. So the past number of years, including just very recently,